Hello, and welcome to the ninth episode of our monthly podcast series, Market Matters. Each month, we'll bring you big picture insights from leading investment specialists exploring the opportunities and challenges faced by investors in today's markets. Today, I'm joined by Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. So, Annabel joined the AIC in 1997, 28 years ago. She currently leads the AIC's Communications and Promotion Strategy, sharing the uses and benefits of investment companies with the media, opinion formers, advisors, and private investors. She also encourages member companies to communicate to investors in a clear and engaging way. Annabel is also an ambassador for Women on Boards, the Diversity Project, and ACT Global Leadership Council. Annabel, thanks for joining me today.
Really delighted to be here with you.
Now, you're not far off celebrating 30 years with the AIC, which is obviously very, very impressive. Could you just talk us through how you got into the investment industry and the investment company space in particular, as well as any of the challenges you faced on the way?
Absolutely. So I knew I was interested in markets. I did a BA and an MA in the US actually in geography. And I did a PR course for 1 year at Cardiff University. I then went to work as a graduate trainee at the big PR agency Hill and Knowlton. Very young, very dynamic agency. They had a bar and reception. But it wasn't what I wanted to do. I knew I wanted to work in markets. So I went to work for the AIC, which was very different. It was a very traditional trade association with a very nice but older group of people working there. At the PR agency, I was used to working well into the night, whereas the AIC, when I joined, it was more a 9 to 5 culture, and it was a very male culture as well. So there were no female directors at the AIC. There were no women on the AIC board, and actually the AIC board consisted of heads of investment trusts. So there were actually no independent directors of investment trusts on the AIC board either. Now, I have to say, everyone was extremely nice to me, and I was invited to attend the board, which was great. But I think the real catalyst for change came along when we had a new Director General, Daniel Godfrey, and he and I worked very well together in terms of creating and innovating really a new culture and a much more transparent and proactive AIC.
Now, we mentioned your charity work in the intro. You do a lot with, kind of diversity charities. I mean, could you just kind of talk through the sort of work that you do with those three?
Yeah, I can. I mean, obviously, and perhaps it is partly from my own experience. When I joined the AIC, there were literally less than 5% female directors. There was a very good article at the time saying it was pale, male, and stale, the industry. Now we've got 42% female directors. But, the work I've been doing with the Diversity Project, I'm particularly interested in the Pathway program, which is to encourage and help there be more female fund managers. There are currently only 12% female fund managers in the whole investment industry. That should be a lot higher. They've also opened up a program for traders as well this year. Then the ACT Global Leadership Council, it's very interesting because they have a standard of corporate culture. So you can act, it's a framework which wealth managers or asset managers, they use it to actually assess their culture. And if you think about some of the quite shocking things that have happened in the last, couple of years in the asset management industry, I just mentioned Woodford or Odie, culture really has been a problem. So it shows how important that is.
And looking over the kind of 3 decades you've been with the AIC, what are the real kind of big changes that you've seen within the investment trust industry?
Yeah, well, I've already mentioned the first one, which now it's a lot more diverse in terms of type of people there. But actually, I mean, the industry has really grown. I couldn't quite go back to 1997, which was the year I joined the AIC, but I've gone back to 2000, and the industry's assets have more than tripled since 2000, from 79 billion to 260 billion today. The average size of the company has more than tripled from 218 million to 700 million today. But actually, what they invest in is just so different now. So when I joined, it was mainly equities, and there were some private equity unquoted companies trusts. Today, for over 40% of our assets are in alternatives, so including infrastructure, renewable energy infrastructure, property, debt, and the closed-ended structure of investment trusts has worked really well for these types of hard to sell illiquid assets.
Yeah, for sure. Now, kind of sticking with this theme of change, what do you kind of see as the role of investment trusts in a world where more and more investors are exclusively using passive solutions, be that global equity trackers or bond funds? Obviously, you mentioned the amount of kind of new areas, new asset classes that are kind of being invented for retail investors, really.
Absolutely. And I have to say also access to unquoted companies. If you think about sort of traditional global investment trusts, now a considerable number have a high percentage in unquoted companies. So it's those hard to sell assets give us a real edge over trackers. But I have to say, it's been an environment that has been particularly suitable for trackers. If you think about it, if you look at the MSCI world, say about 20% of that is in the Magnificent Seven. We've seen some extraordinary performance from the Magnificent Seven and larger companies. Now, it's interesting because recently we've been seeing signs perhaps of that changing and a transfer, a reallocation of capital away from the US to Europe and the UK. And I think investment trusts really have a big role to play in these types of assets. And I think things are probably looking up for us as an industry at the moment.
Yeah, absolutely. I guess it would be kind of maybe remiss. I was thinking about a kind of what question this would be, but maybe remiss to kind of not to talk about I guess, the income benefits of investment companies
Yeah,
as
I'd
well,
really like.
dividend heroes, that sort of thing.
Absolutely. For private investors, investment trusts have great income benefits. We have 20 investment trusts that have over 20 years of a record of dividend increases every single year. We've got 10 that have increased their dividends for over 50 years. And the way they can do that is because they don't have to distribute all their income to investors. They can retain up to 15% of the income, and then when times are tough, so for example, during the pandemic, then they can use that income in the revenue reserve to boost their dividends. Now, private investors find that incredibly reassuring because, of course, they want that reliability of income.
Yeah, and that kind of, I guess, that dividend hero initiative. I mean, it's been really really great kind of marketing tool for those investment companies. I mean, I wonder whether you can kind of remember how that kind of came about and the thought process behind it.
Do you know, I know very well how it came about because myself and my colleague at the time, Gemma Jackson, brought it about. We innovated it, we brought it about, we invented it. And it did come about after the global financial crisis, actually. And that's what made us think about it because I think we innovated it in 2009. And it was because we'd seen a huge amount of companies cutting their dividends, a whole load of the open-ended funds cutting their dividends. Obviously, it was a very tough time for investors. And it became clear to us that investment trusts had this, for want of a better word, superpower where they could actually continue to increase their dividends through tough times. So that was the thinking behind it actually, and that's why it came about at that time.
Amazing. Now, talking about kind of tough times, I mean, discounts today in the investment company world are particularly wide at the moment. Now, there's plenty of reasons for that, which we'll kind of cover a little bit more in depth shortly. But we have seen some kind of opportunistic bids coming in because of this. Do you think this kind of shows the value that's on offer from the investment company space?
It definitely demonstrates the value on offer. If we go back to 2000, and if you go back to 2020, not very long ago, actually, discounts, at 1.9%, pretty much close to an all-time low, quite honestly. If you look at that today, the average discount is 15%. Now, we've done a lot of research on this. We know historically investment trust returns after periods of double-digit discounts are strong. And our research shows that if you've invested at trusts at a discount of more than 10%, then the average return is 13% per year over the subsequent 5 years. So I think everybody is waiting now for a catalyst to come along, and I think perhaps Trump's tariffs may be the start of that, quite honestly. But also, of course, now today we've seen interest rate cuts, and interest rates are coming down again would be very helpful, particularly for those interest rate sensitive sectors like property, infrastructure, renewable energy.
Sure. Now, I wonder what you kind of made of Saba's failed attempts to take control of 7 investment trusts, and in particular, I guess the response of shareholders in turning out in numbers to defeat the proposals.
Yeah, well, Saba's proposals were radical, and I have to say that they were not a typical activist proposal. They were targeting 7 trusts, and their proposals were to get rid of the independent board of directors, appoint one of their employees and one other director that they'd appointed themselves, and to completely change the mandate of the company into a company that sort of effectively ate up other trusts. Um, and I actually think it's a very proud moment for our industry because everyone, whether it's boards, managers, wealth managers, proxy agencies, analysts, research houses, the media were amazing, and all those individual shareholders came out and supported their investment trusts. And for all those shareholders came out and supported their investment trusts because they appreciated the long-term strategy of investment trusts, the independent board of directors, and I think they really understood that, when you choose an investment trust, you usually do a lot of research. You look into it, you think about the type of company that you want to invest in, the type of assets. It's not a haphazard approach. And I was incredibly proud of how the industry reacted. The shareholders really value that long-term approach, and that's what that showed.
And I guess kind of since then, we have seen some, I guess, small wins from Saba in terms of some, tender offers and kind of rollovers into open-ended funds or ETFs. Kind of overall, I mean, what kind of lessons do you think that investment company boards or the industry in general needs to learn from this period?
Yeah, well, I think it's important that I make the point that even prior to Saba's intervention last year, we had record share buybacks. We had a record number of mergers between trusts. We had 10 mergers. We had a lot of liquidations. Now, that has continued this year. Clearly, discount management is very important to shareholders. So we have seen continuing record share buybacks. We've seen some manager changes. We have seen 10 liquidations in Q1 this year. So, and other innovations, including changes to fee structures and continuation votes. So I think it's incredibly positive that boards are really thinking about what their shareholders want and putting their shareholders first. In addition to that, I think boards are also addressing the demand side. They're assessing their trust appeal in the market. They've got to continue to think about their communication and marketing and do that effectively to private investors and new buyers, as well as, and this is very important, as well as existing shareholders. I think existing shareholders want a strong level of shareholder engagement with their trust.
Sure. Now, going back to the voting point, clearly another one of the benefits of investment trusts is that shareholder democracy. Now, the AIC has just launched a petition calling on the UK government to change UK company law so that nominees are required to pass voting rights onto the beneficial owners of their shares. Now, we'll link to that petition in the description of this podcast. But I wonder if you could just kind of talk us through the petition and what you guys are hoping to achieve.
Oh, definitely. Well, one thing that really came out of the issues with Saba is that a lot of our shareholders had difficulty voting. Because platforms and nominees do not automatically have to pass on the voting rights to the end users, a lot of our shareholders didn't even know a vote was taking place. Then, when they'd make a decision, some of the platforms just refused to process that vote. And interestingly, with wealth managers, some of them were actually charged for the privilege of voting. Now, this is not acceptable. There was a phenomenal effort to ensure shareholders were informed about the Saba action and voted. We can't leave this to chance. We've got to have a change of company law to ensure that all shareholders can vote, that they get that information and they have the ability to have a say on that trust. And that's why I'd like to really ask your listeners here, please, please, if you do one thing, sign that petition. Because if, we get 10,000 signatures, then we get a question in Parliament, and it just raises this at the agenda because we want to make sure shareholder democracy is so important and it should be a right for every shareholder.
Yeah, absolutely. I think definitely well worth kind of looking at petition and signing. I think in my kind of personal experience through AJ Bell, which I use, I've definitely seen more emails coming into my inbox telling me, you've got a kind of AGM coming up, which is really good progress. But yeah, I think that definitely needs to happen more and more.
I'm delighted to hear that, David, that you're getting more emails and more notifications about votes, but that's what has to happen. People have to have a say. And a lot of our investment trusts are majority private investor held. So, unless they're notified and have the ability to vote, you could have just one shareholder with a relatively small number of shares, really riding roughshod over investors' views.
Now, one other kind of long running issue in the investment trust world is around the double counting of costs. Why
Yeah.
is this such an important issue, and kind of where do we stand today, and what outcome does the AIC ultimately want to see from the government?
Well, it is a very important issue. It's particularly had an impact on the investment trusts investing in alternative assets, so property, private equity, infrastructure, renewable energy. And it has led to some wealth managers selling for sure and has been a factor in increasing the discounts on some investment trusts. And the reason is that the regime, the cost disclosure regime, basically makes investment trusts look artificially expensive, I think is the easiest way I can describe it. So wealth managers, and also if you look at the cost disclosure on platforms, they've added up a list of charges, and their charges predicting the future costs, which is in itself always quite a difficult thing to do, and also perhaps not the most accurate way of going about it. And those charges have included things like gearing costs, they've included the pull through costs of fund of funds, performance fees. I mean, it's important to recognize that all of the internal charges of an investment trust are included in the share price. But these additional charges look like an additional charge to whatever's in the share price. So it makes them look artificially extremely expensive. Now, where are we regulation wise is we've got two consultations. One has closed on consumer composite investments, a rather catchy little name, I don't think, but that's what the regulation is. And we have another consultation that's running. And now we have argued for investment trusts to be outside this regulation. If we went back to 2018, before this European regulation came in, we are very clear that, we clearly want to disclose charges, but we're companies, they're already disclosed in our report and accounts. And, but, so we've asked to be taken out of the regulation, But we have also asked, in case that doesn't happen, we've asked for some simplification of that regulation. Particularly, some good news is there's, for example, suggesting we don't include gearing costs any longer, but we particularly want those look-through costs taking out. At the moment, the regulation is in the crazy situation that passives don't have to include look-through costs, but investment trusts do. Now, that's not right. So hopefully that will get changed. We'll be waiting now to hear when the government's response and the Treasury's response to the consultation. That should come later this year. So potentially another issue that we're hoping to get a good decision on, which should have an impact on investment trust discounts and demand.
Sure. Now, we kind of mentioned very briefly, there's been a lot of M&A and consolidation in the investment company sector recently. And I think that, many within the industry and without kind of envisage kind of having fewer trusts, but ones kind of much larger in scale. What do you kind of envisage the sector looking like in 5 to 10 years' time?
Yeah, I think that's right. I think there will be fewer companies, but they're going to be larger. They're going to be more liquid. They're going to be more cost effective. And I think they will be performing strongly for their shareholders. And I think that's very important. And I think it's very easy to be caught up in sort of doom and gloom. It's been a really tough time. This is not just for the investment trust industry, it's for the open-ended industry as well. It's for generally for the UK market. Quite honestly, it's been a tough time. We're beginning to see some signs of things, a reallocation of capital, and let's hope some of that reallocation comes towards the investment trust sector. But investment trusts have been in existence since 1868. They're over 150 years old. They have been through the world wars. They've been through the financial crisis. They've been through the Great Depression. They've been through so many, absolutely global and difficult events. And what they do is they adapt to meet investors' needs. They're incredibly innovative. They are investment pioneers. So, quite honestly, actually feel very confident about the sector's future. Clearly, we're going through a period of consolidation, but I think it's a good time to invest in investment trusts. Discounts are currently wide. I think performance is going to improve, and I think we've seen some signs of that already. But also, we're seeing a huge amount of corporate activity. So if you're an investor, you're either going to benefit from improved performance or corporate activity. So it really is a great time to get invested in investment trusts.
Hopefully something we can all agree on. Annabel, thanks for your time today. It's been a really fascinating chat.
Thanks so much, David. I've really enjoyed talking to you.
Now, as I said, we will link to the AIC's petition on voting in the description to this podcast, and listeners can find out more insights on the Kepler Trust Intelligence website, as of course on the AIC's website. Thanks for listening today, and we hope to see you soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.